Hello and welcome back to Chapter 4 notes. And so in this lecture, this lecture video, we'll talk about break-even, we'll talk about target profit analysis and operating leverage, okay, and margin of safety. And so when we're talking about how to actually calculate break-even, we can use our break-even formula. So in terms of units, you just take your fixed expenses plus profits. Now, I include profits here because it's the same formula for the target profit. But remember, at break-even, profits are zero. So it's going to be really just fixed expenses divided by the contribution margin per unit. That will give you the break-even in terms of sales units. In terms of sales dollars, we can take our fixed expenses divided by our CM ratio. Okay? So if we apply this to what we've been dealing with here with our RDC bicycle, we can say our fixed expenses are 800, and then remember our CM per unit is our 200. So just come over here and we take our 800 divided by our 200. Remember, we have to sell 400 bikes. Now, how do we do that in terms of sales dollars? Well, because we're only dealing with one bike, we could just take the 400 bikes times the sales price per bike, which is $500, to give you the $200,000. Or you can use a formula. So in this case, maybe we take our 80,000 and we divide that by our CM ratio, that you recall we did was 0.4. And the way we got that 0.4, remember the CM ratio is contribution margin divided by sales. So in this case, 200 with variable contribution margin per unit divided by the sales price of 500. That gives us our 0.4. And so when you do the math right over here, you get that $200,000. Okay, you get the $200,000 either which way. You get the same answer. Okay, doesn't really matter. Let me move on to target profit, which is the next page. And so the target profit applies the exact same formula. So it's fixed expenses plus profits divided by the CM per unit, or fixed expenses plus profits divided by the CM ratio to get the target profit dollars. Now, let's take a look at this and assume that we want to make $100,000. Okay, so in that case, the profits is not zero; it's $100,000. So we take our fixed expenses plus our target profits divided by our CM per unit, and over here we take our 80,000 plus our 100,000 divided by 0.4, and then that will give us our target profit. And so when you do the math, you get 900 bikes. You have to sell 900 bikes to make $100,000 in net operating income. And over here, that translates to $450,000 in sales. Okay. In this case, again, you could take the 900 bikes times the $500 per bike to get to the 45. That's because we sell one bike. But if you sold multiple bikes, as we'll see in another problem, that muddies the water quite a bit. It just might be easier to get into using it in terms of the sales dollars. Okay. So on the next page, I have a quick check problem. Why don't you go ahead and give this a try? You may even want to pause the lecture video to see how you did on this problem. Okay. So I'm going to go ahead and go over this. So we come over here, and we have our fixed expenses plus our profits divided by our CM per unit. Okay, because this is not asking you sales dollars. So you just come over here, $1,300 are our fixed expenses. Our profits are $2,500, and I calculate my CM divided by 1.49 minus 1.36, and when you do the math, you get A. Okay. Talking about the effect of income taxes, okay, on target profits. So what we've been dealing with so far, right, is only dealing with net operating income. But sometimes we might want to figure out, what about net income? Okay, so in that situation, right, to determine the target net income, CVP calculations for target net income must be stated in terms of target net income rather than target net operating income. So, for example, a company might be interested in knowing the quantity of units that they need to sell to earn net income of 960, assuming this is the tax rate. Okay, so in order to calculate target net income, not net operating income, but net income, we have to consider the tax rate. Okay, so the way we're going to do that is we're going to come over here. We're going to take our fixed costs plus our target net income divided by 1 minus the tax rate. And that's because we could come over here and we could say our net operating income. Okay, our net income equals our net operating income times 1 minus the tax rate. Okay, so in that case, we can take our target net income divided by, if I come over here, I'll write that down here because I ran out of room, equals NOI times 1 minus tax rate. In that case, if I say net income divided by 1 minus the tax rate, okay, that gives me my net operating income. So what I could do is I could take my target net income divided by 1 minus the tax rate, okay, and then that's going to give me my target net income, and then in that case it becomes the same old target profit problem. Okay, so we say over here, assuming fixed costs are $2,000, target net income, not net operating income, but net income is $960, and the effective tax rate is 40%. The CM per unit is $80. The number of units that need to be sold to achieve a net income of $960 is as follows. We take our $2,000 plus, this is our net income divided by 1 minus the tax rate, gives us the $1,600. This is the target net operating income. So it becomes the exact same problem that we did on the prior page. Fixed expenses plus target net operating income divided by CM per unit. You have to sell 45 units. Okay. The next thing I want to talk about is the margin of safety. Okay, so the margin of safety is the excess of budgeted or your actual sales beyond your break-even point in terms of sales. Okay, so if we look over here and we say our RVC, let's assume that our RVC has sales of $250,000. What is the margin of safety? Well, if they're currently selling, or they think they're going to sell $250,000, how much in terms of sales dollars is that above the break-even? Well, remember, break-even in terms of sales dollars. Remember, we had 400 bikes for break-even, which gave us $200,000 in terms of total sales. That means the margin of safety, right? How much is your total sales, your total actual sales, above break-even? Well, if you're actually doing 250 and break-even is 200, you're $50,000 above break-even. Okay? So MOS is $50,000. Okay? So basically that's telling you if you're currently doing sales of 250, sales fall by 50,000, you stop making money. That's what this is telling you. Okay? So then the other thing is I can make that in terms of a percentage, right? Is I could say my 50,000 divided by my current sales of 250 gives me my 0.2, or 20%. So what this is telling you, right, is that if you're currently selling 250 and your break-even is 200 and sales fall by 20% or $50,000, you stop making money. That's what this is telling you. Okay? We can also do it in terms of units. Here we did in terms of sales dollars, but we did in terms of units. Assuming sales of $250,000, how many units were sold? Well, 500. Okay? And we know that break-even is 400, so the MOS equals my 500 minus my 400, so the MOS, the margin of safety, is 100. As a percentage of units sold, 20% again. Okay? 20% again. Sales fall, if you're currently selling 500 units and they fall by 20%, which means that now you're selling 400 units. At 400 units, you're at break-even, and you stop making money. Okay? So why don't you go ahead and do this quick check problem. I would recommend you stop the lecture video and give it a try, and then check it. I'm going to go ahead and go over this now. So I'm going to take, remember, I take my first thing I have to do, this one's asking you to calculate margin of safety. The first thing I actually have to do is calculate my break-even. Okay? Because the margin of safety is the number of units that you're selling above the break-even. Okay? So the first, I have to calculate my break even, which is then going to be equal to, I have my 1,300, okay, divided by my $1.49 minus my minus my 0.36, which gives me my break even of 1,150, which you can see that's one of the answers. That's actually the break even point, which is not the margin of safety. The margin of safety equals what you're currently selling, 2,100, minus the break even. So the right answer is going to be B. Okay? The last thing I want to talk about in this lecture video is operating leverage. And so cost structure has implications for profit. And so cost structure is talking about the relative proportion of your fixed costs and variable costs. And remember, we can separate our total costs into fixed and variable. So what is the proportion of your total costs that are fixed versus variable? Okay. Now, when we talk about a corporation or a firm that has a high fixed cost structure, what we're saying is that income will be higher in very good years compared to companies that have more variable costs. On the other hand, when you have a high fixed cost structure, that means that income will be lower in bad years compared to companies that have more variable costs. Okay, let's say companies with a low fixed cost structure can enjoy greater stability. So if you have a higher fixed cost structure, that means you're a little bit riskier. You're going to have wider swings in income when sales go up or down. Okay, that's what that's telling you. So you look over here. Operating leverage we can calculate operating leverage, and it's a measure of how sensitive net operating income is to our percentage change in sales. Okay, and it does take into account, operating leverage takes into account the cost structure. So that's why I talked about the cost structure first. Firms with high fixed costs have high operating leverage, and vice versa. Okay, so the way we're going to calculate our operating leverage is we're going to take our contribution margin divided by our net operating income. So maybe remember the way that we get from contribution margin down to net operating income is we subtract out our fixed costs. So if you think about it, a firm that has a high fixed costs, right, is going to have high operating leverage. Okay, it's because that the contribution margin is going to start to be a little bit lower, and so your fixed costs, your operating leverage is going to start to go up. Okay, so if we look over here and we calculate our degree of operating leverage for RBC, we need to do this in terms of total. We take our 100,000 divided by our 20,000. Okay, and this is going to equal our 5. That is our operating leverage. Okay, the higher this measure, the higher the fixed costs. Okay, so if RBC increases their sales by 10%, how much will net operating increase? It'd be a good idea for you to stop the video right now and just give this a try. You can do it the long way over here by looking at the comparative income statement, or I'm just going to show you the shortcut way. The shortcut way is to take your operating leverage times the percent change in sales. So in this case, we go 5 times our 10% equals our 50%. Income will increase by 50%. Okay? So on the next one, why don't you do these two problems, these two quick check problems, and then we'll take a look. Okay? So in this first one, we have to calculate our contribution margin and divide it by our net operating income. So our contribution margin is going to be equal to, we have to do it in total, 2,100 times $1.49 minus my 2,100 times my 0.36. This is my total sales, my total variable expenses, divided by my net operating income, 2,100 times $1.49 minus my 2,100 times my 0.36 minus my fixed costs. And when you calculate it out, you get A. And then coming over here, all I got to do is go 20% times 2.21. Income will increase by that much. Thank you.